Hey everyone, Happy New Year. Wanted to check in to talk about a few points of what happened in capital markets last year and what we see coming down the pike in 2023. We all know last year there was a lot going on with geopolitical risks. That was a big deal. There was also growth headwinds, and we had inflation hike up dramatically to over 9% last summer. That's a big deal. That hasn't happened. We haven't seen inflation numbers like this in many, many years. The Fed told us back in 2021 that this inflation was going to be transitory. Don't worry about it. It's going to be quick. But it turns out not so much. It's been around, it's remained, and in fact, inflation is still over 7%. So they still have some work to do for sure. The Fed has two major mandates. One is to keep full employment, and the other is to keep inflation in check and low. Now, labor markets have remained strong, which has allowed the Fed to continue to hike rates. So that's what they've done. Right now, the Fed funds rate is between 4.25 and 4.5%, and their terminal rate is a little bit over 5%. That is the rate that they say that they're going to stop hiking. I think they might end up a little bit higher than that, but we will see. The Bureau of Labor Statistics came out actually yesterday. These are numbers from last November, and there are still 1.7 job openings for every unemployed person in the country. So labor markets are still percolating along. We're seeing some layoffs, but pretty strong indeed. Last year, bonds really took it on the chin because of what has happened with inflation and interest rates going up. The value of bonds went down a lot. We didn't have any yield to play with. So we do see bonds being a bit more balanced in your portfolios this year, as we've got 4.5% yields that we didn't have last year. Still a little bit of risk to principal as they hike. I talked about this terminal rate a second ago. So as they hike, still a little bit of risk to principal, but again, we have yield. So bonds will be balanced. That is the hope. Next is the discussion of the dreaded R, the recession word. We think it is likely, although we're hopeful that it will be somewhat mild. We still have an inverted yield curve, which does portend a recession. It's been a pretty good indicator over the last 3 decades or so, and right now the short-term Treasury bills are yielding about 4.5%, and 10-year Treasury bonds are yielding about 3.7%. They're the inversion. Last year, growth headwinds, the stock market down. This year, we see volatility again because of the recession I mentioned. We're hoping it's less than what happened last year for sure. And also, when we look at historical data as it relates to how the stock market performs in a recession, there are times where the stock market does perform pretty well. So we will see. We're hoping for low volatility for sure. At the end of the day, we have talked to all of you about your allocations and how in particular they tie back to the long-term family objectives. So we're very confident in what we've built. But as we always say when we do these videos or have our conversations, we are here. If you'd like to chat about any of it or any of your financial planning needs, please don't hesitate to reach out. That's what we're here for. So have a wonderful new year. Have a happy new year. And please let us know if you need anything. Thank you so much.